We good here?
Yep, you're good. The next 40 minutes, the room is yours.
Check one, check two, sibilant, sibilant. So I realized when I sent this presentation, at the end I make an offer. I'm actually going to make the offer a little different. I want to lead this off because we're going to be doing something nice. I'm going to make an offer on my kind of intro to options course for $17, which is the price of the VIX at the end of the class. Use code OPVIX. And rather than pocket the $17, I mean, I like 17 bucks, but now that in Chicago that gets you maybe a cup of coffee. Donating those assets to charity ahead of Christmas, I think, is a much better thing to do. So everyone we sell using OPVIX, I'm going to donate that 17 bucks to Catholic Charities, and who does a great job with the homeless in the city of Chicago. So that is going to be our running special. So you're going to get yourself a better deal and help other people. And yeah, well, and you know, it was fun listening to Morgan talk about being a Cubs fan. As a guy that lives a half a mile north of Wrigley, I think about the worst trading loss I ever had, and it was a doozy. It still does not compare to the heartbreak of losing Game 6 to the Marlins in 2003. I still feel that sting, and it just an absolute that I'm still just caught up over it. And then to watch the Cubs get swept out of the playoffs 2 years in a row, just maybe the worst feeling of my life. So, anywho, with that in mind, let's get to the presentation. Principles of risk management. I'm going to talk about. I wrote a book called The Option Trader's Hedge Fund, and this is kind of a great outline of what we get into in some detail in the book. And then my coursework is really, you know, if the book is a nice guide, a real guidebook, the course is kind of the step-by-step, if you will. Yeah, oh yeah, sure. Can I post the link now? Sure, www.optionpit.com/mentoring. All right, and you just click on that silver course there, and use OPVIX, and you'll be good to go. So, yeah, use code OPVIX. It is not case sensitive. So, you know, a lot of people, they spend so much time thinking about individual trades, they don't think about how they're going to manage their money. And the number one way I see people blow up, not lose money, but really blow up their accounts, is from lack of money management. So let's talk. So we're going to discuss what is risk management, where to start. We're going to talk about a money plan, a trading plan, and a trade plan, and then I'm going to briefly cover portfolio insurance. All right, what is risk management? I thought this was fun. I went to the Merriam-Webster dictionary and put risk management into their dictionary, and this is what they came back with. And the word you've entered isn't in the dictionary. Click on a spelling suggestion. So I thought it was funny. You can use that if the silver course is the one. I'll obviously donate the $17 or whatever. If you're interested in a higher coursework, I will gladly make some sort of donation in your name. Yeah, risk management. George Costanza could explain it. That's funny. My definition for option traders, and traders in general, actually, the taking of risk in the most capital-efficient manner, as such to receive the highest possible return for the fewest amount of dollars. All right, that's really it. All right, it's all about people that have good risk management skills are efficient with their capital. That's what it is. So how can you be efficient? All right, before you even start, understanding risk. All right? I think Dan Cook from Natix would tell you before you trade our products, learn them. That's why he's here speaking. Morgan would say the same thing. Before you trade any product, you have to learn how that product functions intuitively. All right? My first cousin is a pilot, and my best friend flies helicopters for the Army. They each spent about a year of classroom before they got really into flying for the Air Force and the Army, respectively. All right? Why? All right? Then they went in and did a bunch of time in the simulator. Why? So when you're flying, you're really prepared for what can potentially happen. You understand what's happening to you. All right? Getting action put into your head so that they're intuitive, so you really understand what you're doing is the key. All right? So with options, all right? How does one read an options quote? All right? All right? How do options price? All right? How do option synthetics function? All right? How are calls and puts related, in other words? All right? How does the pricing model work? All right? How do the Greeks function as an output of the pricing model? All right? And what are the non-modeled risks of options? All right? Before you start thinking about actively trading options, all right, beyond a one lot, you need to get to here. To how do the Greeks function as an output of the pricing model? Not just what are the Greeks, how do they actually function? Then, if you're going to be a real professional trader, what are non-modeled risks? And it should be that way with everything, right? When you are getting down to business, learn your product so well you understand the non-modeled risk. All right, so that's great. So why do you need to know theory? People love to say, I don't need to know theory. I don't need to know options or futures and how they work. I can just look at a chart. I can look at a risk graph on, some TD or on TradeMonster or LiveVol, and that'll tell me exactly what my risk is. Well, that's the problem, is they don't. If you don't understand how the model works, you can't really properly use risk charts, because risk charts are based on a model, right? I can think I've got the world's best pitching staff on paper, right? But that's not necessarily how it's going to work. I can think that I've got a perfectly good working airplane, but that's not necessarily how it's going to work. It's modeled. It's annoying, all right? And you can get to shortcuts. That is fine. But before you get to shortcuts, learn the right way, and then put in shortcuts, all right? Understanding the cause of risk is the key to managing risk. I do a lot. I spend so much time. People think I'm a broken record because I spend so much time telling people you have to learn this stuff intuitively. But people don't want to take those shortcuts, and you can't do that. Yes, they're being recorded. One more thing. Understand the contract you are trading. You have to understand the contract. You can email me for the slide. All right. You would be shocked the number of people that are trading a gold. You would be shocked how often I run into somebody that is trading gold futures that doesn't know how many troy ounces are in a gold future. Or people trading corn options that don't know how many bushels are in a corn option. Or that SPX settles into cash. Or that ES options settle into futures, except for on the quarterlies when they settle into cash. Or that SPY settles into the stock. Understand, what are the dollars at risk? What is the multiplier? What is the tick? What does it expire into? When does it expire? All of these things are things you need to know. You'd be shocked the number of people that do not want to take the time to read an information circular on a future or whatever. You need to know. All right, now let's talk money management. Once the trader is actually ready to trade, he understands the product, knows the product. The next step is to build a money management plan. A money management plan will allow for how much of an account will be engaged in the market and how that money is allocated as it's engaged. So, question one, what kind of money do you have to work with? What is your goal rate of return? Notice before you think about what dollars you want to make, all right? I never have people I never want someone to say, I want to make $50,000 a year, all right? Or I want to make $250,000 a year. I work with people to try and get a goal rate of return because it forces them to have some realistic expectations. Okay? So what is the goal rate of return? How can you allocate your capital so that you are able to achieve that rate of return? So you start with you start with two things. What do I have and what is my rate of return off of that I want to get? Then put the two together, all right? And so that how do I allocate my capital so that I can achieve that rate of return? Now, here's where a lot of people fail to recognize. Can I get that goal rate of return without the risk of blowing up my account? General rule of trading, you should always be able to trade the next day, all right? Should always be able to trade the next day. Jake Peavy, when he's down nine runs in the fourth, is not going to blow out his arm. All right? He's going to prepare himself to come back for his next start. He's going to say, I'm going to get over this loss. Think that way, all right? So you can't set yourself up so that you can blow up. All right? Now, is the plan efficient? All right? Does it use your money efficiently? And then finally, and this is another really important one, does the plan scale? Does the plan scale? Capital. All right, different accounts warrant different approaches to trading. Do not trade any capital lightly. Any. All right, when I was a trader, I had people fired for losing a couple of $1,000 if they were lazy about it. I had a second guy blow 50 grand, but it wasn't, that is in itself an interesting story, but it wasn't his fault in the same way, and he wasn't lighthearted about how that went down, and so I did not get him canned. So do not treat any capital lightly. All capital is part of building success and wealth. All right? I truly believe there's no such thing as throwaway capital. Treat every dollar as if it matters. When you're learning to trade, I don't care if you've got $1 million. I don't care if you've got $10 million. I don't care if you're like Morgan Busby and you've got $95 billion. I don't know if you know that, but Morgan has a monocle. He walks around with in his left eye all day, and he goes, "Man, see, we're going to light our cigars with my $1 billion here, yeah." No, I'm just kidding. Morgan is the opposite of that. But so I'll share my billions with you guys. That's nice. So the richest guy in the world treats every dollar as if it matters. It's the fool that blows his money. The McAfees of the world, the McAfees of the world, that treat dollars lightly. So, just to put things in perspective, let's look at some things that cost $6,000. All right, you could get this really sweet silver Camaro coupe with 76,000 miles on it, for less than for $6,000. All right, a lot of Sox fans going to see Jake Peavy driving in those cars. I can tell you that much. You could get yourself a pair of Christian Louboutin shoes and still have $100 in your pocket. You could get yourself an A-Rod rookie card, $6,000, with an autograph. Quite the deal. I'm thinking that's probably worth a little less than that now. So, for those of you laughing about the shoes, if I put so those are priced at $5,900. If I put $5,000 in C notes in my left hand and that pair of shoes in my right, in my wife's shoe size, and said pick one, I would still have $5,000. I still have $5,500 large in my left hand. All right. So that is no laughing matter. Those shoes. Now, return. All right, be aware of what is a realistic rate of return. All right, is 5% a month a realistic number? All right, compounded, that equates to about 80%. Okay, that's pretty impressive. So, will experienced guys do 5% a month, 6% a month? Yes, guys that are proven and good at this shoot for that kind of number. Is 2% a realistic return? Compounded, that equates to about 26%. That would be just about every hedge fund on Wall Street. And we have people out there that walk in a room and say, you can make 2% a month in your first year. Be realistic, guys. It's not a fun discussion. You know, I'm out selling educational product, and I'm talking down returns. Kind of seems a little counterintuitive to people, but the fact of the matter is I think realistic expectations when you set out are what are going to stop you from making silly mistakes and will help you hang on to dollars. Allocate capital. How much of your account should stay in cash? What is the target rate of return on traded capital to achieve the trader's goal rate of return? And ceteris paribus, how should capital be allocated into each trade to achieve a target rate of return? Assume the same target rate of return for every trade. Allocate trading capital across trades. Mark, will you look at every month or at the end of the year? I think a little of both. I think it's important to look at your monthly return and your annual as a whole. You know, if you're seeing, I don't let my entire life hang on one month, but if you see a couple months in a row where your return is coming underneath what would meet your annual target, then you need to look at what you're doing, and you should actually constantly be evaluating what you're doing anyway. All right. Yeah. We look at, yeah, more than X, right. So then allocating capital across trades. So then the risk of blow up, this is huge. When allocating capital, one common mistake is the too much of a good thing approach. Traders need to be diversified, aware of the risks of long, short premium, aware of the maximum loss and catastrophe. Take appropriate steps to ensure that one is always able to trade and never be short what I call units. Those are cheap little options, cheapies. All right, now, evaluate the plan. Once the money management plan is in place, make sure to evaluate the plan after its completion. Is there too much concentration on one short premium spread or another? What is the net Vega exposure? Is there enough long realized volatility exposure? Is there enough cash? Is there enough insurance? Important questions. Is it scalable? This is a key thing I work with people. I don't care if you have 20,000, 200,000, or 200 million. You should be able to execute your plan, give or take. All right? A lot of people will shoot for the stars on a $20,000 account. All right? A lot of people will shoot for the stars on a $20,000 account, but they will not do that with $200,000. Why? Well, you know what? Once you get into real dollars, the pain of losing is a lot harder. You know, 2% going for 2% a month on a $10,000 account is $200. Going for 2% on a $100,000 account is $2,000. Now, if you're risking a couple of $1,000 for that $2,000, that's fine. But if you're risking $8,000, $10,000, $15,000 for that $2,000, then the plan, and you can't afford to lose it, that plan doesn't scale. If it doesn't scale, it doesn't work. You know, one of the things, you know, Dr. J, I find, I have mixed reviews of Dr. J. I like him. How do you find scaling? Being able to trade a $20,000 account that's similar, maybe not exactly the same, but similarly to how you would trade a $200,000 account or a $2 million account. If you're trading a $10,000 account and putting $9,000 of it at risk, would you trade a $200,000 account and put $180,000 at risk? The answer is probably no. Anyway, Dr. J, you know, I like him. He's a nice guy, but sometimes I'm very lukewarm on him as an educator. But the one thing he says that's very, very smart is that the average retail trader takes the risk that would have gotten him fired for at any firm that he was with. Absolutely, 100%. And I agree with him. The average retail trader takes risks that would get them fired by just about any professional trading firm. Now the trading plan. This is the nitty-gritty of the capital allocation. It assumes all trades are in tradable but not spectacular conditions. All right. Allocates trading capital to each trade in the plan. Then you adjust the size of the trades according to the conditions in the market. All right. You put into place restrictions on losses and target gains. Covers adjustments and insurance. Sample allocation on $100,000. Target return 2%. Cash or cash equivalents $50,000. All right. Trades. Target return 4% on dollars traded then, right? If I need 2% a month on 100,000 and I'm only going to trade 50, I need to target 4% on my dollars traded. So condors or condor equivalents, strangles if you will, you might put in 16 grand. Butterflies, you might do 8. Time spreads, you might do 8. Back spread, VIX-based trades, units, cash held back for adjusting. All right? You could be any number of plans. All right, and you might end up with something like this. All right, cash in, 4 grand, cash collected 2. Butterfly, cash in. Units are cheap options. Yes, cheap options that are, we call them less than 1% of the price of the straddle. Dr. J, I get it. That's funny. Butterfly, you might take in 16,000 in cash and collect 1,600. Back spreads, you might do 0 and collect 350. VIX-based trades, you might collect 700. And you might have I mean, you can have all sorts of things. What is the delta of the unit? Less than 5 usually. You should already know that, person asking. Question is, what is the delta of the unit? And the answer is less than 5 usually. Closer to 3. All right. You know, VIX-based trades, units are cheap little things. So your net cash that you make on the month is $36.50. The monthly return is $36.50 on $100,000 bucks. Boy, that's way better than 2%, right? Right? But do we think those trades are going to work 100% of the time, or even 80? All right? We need to assume a lot of things. We're going to have months where we lose. We're going to have months where we don't hit targets. We're going to have months where adjustments to positions reduce potential return. You're going to have all kinds of things that are going to screw up your return. So setting things a little higher and then accepting lower, you end up happy. All right, now the trading plan. And I will say this. There's a lot of guys that will come in and just say sell premium, sell premium, sell premium, sell premium. That works until it doesn't, and then you'll blow up your account. I'll tell you, just anecdotally, and I'm not trying to pitch, I do not run a newsletter service at all, on any level. All right, we're an educational firm. But we do post a strategy letter because we want our students to kind of see how we think and what we do and why and how. Andrew and I have been running this strategy letter since February. We've run a beta test on it, and our net risk has been about half of the beta of the S&P 500, and we're crushing the return on an annualized basis, near 20%. And the reason being is we basically never take systemic risk. Our net Greeks at the bottom of our portfolio at any given time are usually about 0. All right. So now, and so that's what I mean by a good trading plan. You don't necessarily just have to sell premium. You know, I tell people, don't be a premium buyer, a straddle buyer. Don't be a premium seller. Be a premium trader. All right? Just like you would never meet somebody that's like, I only sell S&P futures, right? Or I only buy S&P futures. Would that make any sense to anybody? I only buy binary options. I only sell binary options. All right? A pitcher. I only throw fastballs. I don't throw curveballs at all. You need to mix it up. Otherwise, the market will hit you out of the park. I guarantee it. All right, so finally, adjust allocation according to what trades are more or less favorable. All right, if butterflies are statistically more favorable than time spreads, do more butterflies. If condors don't look good, don't trade them. Cash is a position. Cash is a huge position. I'll tell you this much. Your return will, if you skip trading for a month and don't lose 2%, you are killing it will really assist your return. All right. Now, what is the most important part of managing risk of a trade? Starts with picking good trades. Good trades make risk management easy. All right? And this goes back full circle. How does one enter a good trade? Take the time to understand what are the best conditions for each trade, and then build an adjustment plan. All right? What do you think, guys, what do you think is market makers on the options exchanges and the stock exchanges and whatever, their edge is the bid-ask spread, right? What do you think is a retail trader's edge? What is the retail trader's edge? And there is one. You guys have a huge edge. Most of you just fail to use it. Got some smart. Yeah, trading. We've got some great answers. You know, trading what you want, when you want, not trading. We can be nimble. You have what I call the ability to initiate. Selectivity. Exactly. The most powerful weapon a retail trader has is the ability to initiate a trade. Do not give that away by blindly selling because it's 30 days to expiration. Always have a reason to trade. I am trading this spread because X, Y, and Z. All right? The stock is creeping higher. Volatility is overpriced. And I would buy the stock back if it got to this level. That is a great reason to sell a put spread. All right? Not a great reason. I am selling this put spread because I sell a put spread in IBM every month. That is the single dumbest reason to sell something. Thank you. And I have no problem, you know, and if I'm blunt, I'm sorry. All right, now, keys to a trade plan. Write up the optimal conditions, normal conditions, and no trade conditions for you. Write up an adjustment plan for any potential conceivable move. Underlying rallies, IV down and falling. Underlying rallies, implied vol up and rising. Underlying falls, implied vol is up but falling. Those are, you know, just go through everything. All right, now set a maximum loss for each trade. Set an absolute max loss for each trade. All right, now the max loss is the level that you would close a trade. All right, I'm down X dollars, I close the trade. What is absolute max loss? Well, one of the things I found is these kind of weird intermediate areas where people are losing some, but they're not at their max loss. And they're not sure if they should adjust or not, or they should do something to their trade. If within if it is conceivable for a trade, for the underlying to move to a X dollar amount, and for you hit the absolute max loss number, you need to make an adjustment now. You don't take it overnight. Absolute max loss is designed to stop you from going in overnight with a small loss and waking up in the morning with way through my absolute max loss, way through my maximum loss. All right? Keeping an eye on an absolute max loss will help you manage your max loss. All right? One of the hardest things for traders to do is deal with when a trade is down but not at a maximum loss. All right? This will save you money. Guarantee it. So if absolute max loss is within a one-day standard deviation, the trader should adjust regardless of the max loss. All right, so get that. If the absolute max loss is within one standard deviation, adjust it. All right. Now, for every trade, there is likely some variant of adjustment that is going to work well. However, there are important keys to adjusting that will ensure that one doesn't blow up their account. I've actually seen more trades blown up from bad adjusting than bad trade initiating. All right? And also, you know, throwing capital, and I'll talk about this, always close cheap shorts and be smart about adjusting. All right? So I like this. This is a very simple trade I think, for traders. I call it the third rule. Set a maximum loss. When you're at a third of that maximum loss, make an adjustment to reduce your risk. When you're at 2/3 of max loss, make a second adjustment to reduce risk. When you're at 3/3 of max loss, kill the trade. That's simple. It's a very good way to manage option risk. Adjusting. And this is one that I think is overly taught by a lot of guys, and it's really stupid and dangerous. Never throw capital at a trade. The idea of simply adding a butterfly or a calendar to a trade is a bad idea. Rolling and increasing size is also typically a major mistake. Try to add as little capital as possible when you're adjusting. Keep your margin as tight as possible. All right? Paul Tudor Jones used to say, never add to a loser. All right? Or he also used to say, losers average down. Those were two of the things he used to say. Don't do that. All right? Cheap return targets and maximum loss of original trade. Do not add in the capital from the adjustment. Never open up a cheap option. So never buy or sell a cheap option unless it's just for insurance. And then try to stay contract neutral. All right, insurance. And I was going to tell a couple of stories, but you know, we have this thing called, we used to call them teenies or units, and they're basically options that cost a nickel. A couple of months ago, I was talking to a guy was trading big money, and he wanted to, he was thinking about working with me, and he showed me what he was doing, and this is when I decided not to work with him, and he didn't want to work with me in the end either. And here's what he kept saying: I just sell out of the money strangles in Apple. How can I lose? I said to him, and he was selling really cheap options. You know, I just sell a strangle that's like $2 in Apple. Apple is the first time Apple was 500. And I said to him, that's not within my risk profile. Apple went from 500 to 680. Called him up, you know, we talked a couple weeks later, and he was out of trading completely, blown everything. You know, I had a similar situation. I was on the floor trading. I was looking over my account in Elan, and I noticed that I was short some options that were worth about 15 cents. Yeah. And I went in, and I was long the at-the-money straddle, but I was short these options, about 400 of them, for about 15 cents, and it was a Friday, and I said to myself, why am I short these? You know, there's not really, I'm not really getting a lot out of this. I'm gonna, you know, I'm gonna buy all these back. So then I bought back all of them, and then they actually offered it. They bought them back between 15 and a dime, and then they went dime offer. So I just said, you know, I'm not short still some cheap options on a couple other higher strikes. So I bought 300 more, and absolute luck. 2 days later, Elan announces that their multiple sclerosis drug is killing people, and the stock loses 90% of its value. And had I not bought those cheap options, I would have lost several $100,000. And because I bought those cheap options, I made, you know, a couple $100,000. And even, you know, those extra options were nice. I mean, $20 on 200 contracts is 40,000 bucks. But you know, those did not make or break the trade. So in summary, there are a lot of keys to risk management. I would love to have done 2 hours on this, but 40 minutes. There are lots of keys to risk management. It starts with knowing what you're trading. It moves into a money manager plan, a trading plan, and a trade plan. And then finally, do not short teenies. Buy back. You're going to look and say, I hate buying back nickel options. Buy them back. Buy back nickel options. All right. And yeah, we had the code is going to be OPVIX. All right, it's going to be, you can go to the silver membership here. The code is going to be OPVIX. And you go to that, and it's going to be 17 bucks, and I'm going to donate that money to charity. All right, now it signs you up for an ARB. All you have to do is let me know, hey, kill this. You actually get a free month of my Option Pit Live service, which is kind of me spouting off every day. Yeah, there you have it, folks. It will be available until Christmas Eve. All right, I have it set to expire December 24th. So buy it for a loved one. It's $17. It ends up being $17 on a $149 product. Thanks, Jeff. You're the best too. Any questions for me? All right, Morgan. Always a pleasure coming and talking to your crowd. Would love to come on. We'll have to get a live. We'll have to do a live trading environment one of these times soon again. For those of you looking for an interesting trade, right now I like the FXE. Right now I like the FXE 131 straddle. Thanks, Greg. I really appreciate that. Does the silver show how to make a steady income? I love that your moniker is Be Foolish. It says 92. No, that's wrong. FXE. It's going to take $132 off. FXE. That's the euro currency. The vol of the euro currency. Here, you want to see this, guys? I'll just show you what I'm looking at. It'll take 2 seconds. What was the question here? Oops. Was I stupid to have closed an iron condor at a small loss rather than hold it over the weekend? Probably not. I think that's smart. Morgan, do we have 2 minutes, or do you want me to stop? All right. That's what I love about Morgan. So yeah, I'm looking at FXE which is the euro currency option, and we put this into our strategy letter. And so how do I desktop sharing? Desktop share. I believe I've got it installed. All right. I'm saying I can't do it. Anyway, so I'll tell you what I'm looking at FXE verbally then. And I'll email Morgan a screenshot. But the big thing that I'm seeing is that the implied volatility options that expire in January are trading at a multi-year low. At about 6.5%, and that's actually below the 10, 20, and 30-day realized volatility option. And you just never see a 50. Maybe post the screenshot on Twitter. Oh yeah, I'll send that to you. You'll never see, what was the coupon code? OPVIX. That's Oscar Papa Victor India X-ray, for those of you in the military. What I was looking at was the fact that you will see it realized volatility get over implied, but only when implied is really high because we have some sort of major pop. This is the first time I can think of where I've seen the implied volatility at what I am looking at as an all-time low, and realized volatility well above that number, and that's really, really interesting, and that's what I'm thinking. So, any other questions? I'm gonna email. I'm gonna tweet out to Morgan a screenshot. What's your opinion on iVol services? if I use LiveVol Pro and LiveVol Execution, and LiveVol Execution is probably the closest thing I've seen to what I had as a market maker, and their per contract cost is cheaper than any of the retail brokerage firms out there. So they're actually cheaper than the interactive brokers and a better front end than Thinkorswim. So you do the math on that. Yes, by far. I mean, it's not even close, LiveVol Execution. And I've never seen an execution. It's the closest thing I've seen to when I was trading on the floor. LiveVol X. So that's Lima, India, Victor, Echo, Victor, Oscar, Lima, Echo, X-ray. All right, everybody. I was buying the straddle. Yeah, you don't sell cheap straddle. All right, everybody. I'm going to let you, Morgan, I'll let you get back to business. I want to thank everybody for coming on. And Morgan, anytime
Great.
you
Thank
need
you,
me,
Mark.
I am
Again,
at your
excellent
service.
job as always. And we are recording. We'll post a copy of the recording on our website.